Okay, everybody, hello again. Making this video on March 15th. It's a Wednesday, and I'm going to upload it on my YouTube channel, as I said in a previous email to you. This will take the place of class next week. It's going to be on 321. So a video that I just sent you is going to take class on 316. This video is going to take place of class on 321 next Tuesday. So I will see you all again on next Thursday, 323. So the only purpose of this video is to finish up the bond material. We finished up bonds specifically, but as far as test two material, it's going to be in bonds. Let me make sure this is sharing properly, guys. Excuse me. All right. It's test two. Remember, test one came and included mutual funds. So test two is going to grab bonds and the Federal Reserve, these two. All right. So what I did was I went to my investment course outline, and I'm coming down here. So if we need to see what this is, okay, we're going past term structure of interest rates. We did the yield curve on the last video, the one I just sent you. And so what do we have now? We have the Federal Reserve System, okay, and it's not a whole lot. It's just right here. So what I'm going to do is I'm describing these, and then I'll move to another tab, and it'll be in the Fed's notes, the notes specifically to this. So guys, the Federal Reserve System is the nation's central bank. We call it the Fed, and they have the European Central Bank, they have the Bank of Japan, they have the Bank of Russia. Those are central banks for those countries and those economies. So they're part of the government system. They're not like a private, a company, a publicly traded company like, Bank America or Whitney Bank. It's the government. And they made up of, Federal Reserve board members, and they conduct monetary policy. So if I could encourage us, let me change to another color, because I'm going to encourage us to look specifically at this. Okay, so you could read my notes for the stuff above that, and that's not so important as we're coming down and doing this right inside of here. Okay, because that'll be the crux of our understanding of what the Fed does. There's no calculations to make. It's just conversations. The important terms will be good for test questions, and we just want to be conscious of these. All right, so I'm going to go back to blue. All right. So as when we're getting down to, let me show you what this will be. Go to my mouse. I don't think it's going to let me. Yeah, it's not going to let me do that. All right, so when we come down to fiscal policy, you're seeing it down here. That'll be the segue. Analyzing the economy is going into the next test material, test 3. But you've got the government is in two separate camps, two significant camps. You got monetary policy that's up here, and then you got fiscal policy. That's tax and spend. That's the Congress, okay, administered by Congress. So we're going to leave that into the stock area, and we're just going to put this into the fixed income area, the bond area, because I think it better belongs there. Because when we're talking about yield curves, we're talking about the Fed's manipulation of the yield curve, or the movement in the yield curve based on Fed actions. So their responsible monetary policy is the Federal Reserve, and they're responsible for these two things: interest rates and the money supply. Okay, very simply. And I'm glad the outline's not that long, because all we have to do is keep in mind what they do. So it's the price of money, interest rates, right? And it's the money itself, the money supply. Very simple. So what they're doing is they're using 3 primary tools to affect these 2 broad categories of their job. Okay, I'll read them. We'll go into the notes. I'll explain them, and it's not difficult. But what's going on right now is very active monetary policy. The Fed is very involved in the economy. Sometimes they just sit still. When the economy is doing very well in the late teens, 16, 17, 18, 19, the economy was doing wonderfully well. Didn't hear from the Fed. They kept their mouth shut, basically, and they kept the monetary policy was maintaining itself, and the economy was running well. So it's usually when things are happening adversely, they really get animated. They really come, I don't want to say come to the rescue. They really get involved in the economy. Some people would say they do come to the rescue. So monetary policy tools. So guys, let me clean this up and say right here, these 3 things. So we're going to try to fit it in these 2 boxes. So the discount rate, that's an interest rate. okay? The Federal Reserve requirement, this is dollars to be held on deposit at the Fed. By you and me? No, by any financial institution that's a member of the Fed. So they're conducting all of their monetary policy typically through the banking system because they're the nation's central bank. And that's a way to get to the most money, go through all the banks. So this is a money supply. Okay, I'm going to just put MS. If this is the cost of money, the interest rates, and this is a money supply, and the open market operations, we're going to see that right here. And this is a money supply. Okay, this gets all the attention. When they raise rates and lower rates, that's news all over the world. When they're doing stuff with the money supply, not so much. It doesn't get the same amount of attention, but I would argue it's just as important as the rates of money, or it might even be more important. So again, it's just from an outline standpoint, I'm going to kill this tab, but it's just these couple of things. So I'm going to move over to the next tab, and then we'll see this a little bit better. All right, let's go in here. Let's make sure sharing it is. Okay. And here's the Federal Reserve notes. I'm clicking there, and there they are. Okay, so you could, as the FOMC, the Federal Open Market Committee, is a primary thing. You'll see that acronym throughout my notes. FOMC is a group of Federal Reserve board members that meet on the economy. They're the ones that are saying, should we raise rates, boys and girls? Okay, yes. They take a vote about how much, how long, all those ingredients go into their meetings, the FOMC meetings. They don't meet every month. They meet about 10 times a year. But right now, they have been raising rates since April of 2022, just about every single meeting that they've met. So this has been a fairly aggressive interest rate posture that they're doing. And what is that? It's monetary policy. They're using one of the three primary tools to change the shape of the economy. And one is the cost of money. All right, so you could read these notes. Here comes FOMC again. I really need you to know that because I could easily, that's a test question, I promise, because it's such a big deal. And I would read some of the, guys, this is not long, it's 2 pages of notes, but if you're reading this, it gives you a little bit better understanding about what happened. So I'm repeating here, I'm repeating this, thing that we saw on the outline. So that, because of it being so important, here are the 2 primary ingredients, and here's the way to get those things done. All right, so if we said the 3 tools, okay, first, I'm going to talk about the FOMC as I did before. They are holding open market operations, okay? That's right here. Open market operations is probably the most important single of the 3. How come? Well, because it's conducted every day, right? So what the Fed does, and I'm explaining it in here, is the Fed has a trading room. They like trade. What do they trade? Stocks, bonds, mutual funds, cryptocurrency, currencies. No, they don't trade any of that. They're primarily trading treasury securities, bonds, notes, and bills. What do you mean they're trading them? Well, a trade is a buy or a sell. And why are they doing that? They're doing that to take money supply, put it in the economy, or take it out. So very briefly here, and that's it. But they're doing it all the time. So they're not reporting every trade to the general public. You and I don't hear about this very often, but it's going on. So if they are putting money into the system, let's think about this. So they're going to come out to you or me, and they're going to say, let me sell you a treasury bond. And if you agree, they're going to sell you the bond, and you're going to give them cash. They've just taken money out of the system. Now, you and I have less liquidity, less in our checking account because we gave some to the Fed, but we bought a treasury security out of it. So we're getting what that is. We're getting the interest on it and the coupons and so on. But they were successful in moving the $1,000 out of our checking account. So it's not that they come to us, guys. They go to the big money center banks. They go to Bank of America. They go to BlackRock. They go to all these big, the big mutual funds and all those entities. They come to the Fed when they're conducting a lot of these things, and they're actually part of that trading process. Now, let's do the other way. If the Fed is wanting to take money out, I just described that. If they want to put money in, then they would come back to you and say, let me buy that treasury bond back from you, and I'll give you $1,000 back. And then the debt instrument goes to the Fed, and the money goes into the economy. So they could do this by the billions and billions and hundreds of billions at a time to affect what the economy is doing. So that's the open market operations. I'm going to put a star here because of what I said, because it's operating all the time. It's not, when they're doing interest rate increases, they wait for the time to meet. So that's once a month. And they have 2 months that they skip. So let's say November they skip. And I think it's one of the primary months. The other one I think is May. I forgot which one, but there were 2 of them a year. And it's like, well, okay, then we're not going to, the open market operates, FOMC is not going to meet on interest rates maybe for 2 months, and then they come back at the next month. So that's a long time. Now, could they hold an emergency meeting and meet on that anytime they want? They can, but they don't try to do that. They try to keep it consistent. They try to keep it within their meeting dates, so it's very methodical. So the markets aren't gyrated by, well, they're going to call meetings. They've been calling them left and right, and we don't know when their schedule is anymore because they're calling them, spur of the moment. They don't like to do any of that. So what they can do between those meetings is, again, the open market operations. That's the primary that deserves a star, okay? And that is pointing to interest rates of the money supply. That is pointing to the money supply, OMO, right? All right. So we have reserve requirements and discount rate policy. That's the last thing, and the notes are just about complete. Okay, so the discount rate policy. Now look at what I'm doing here. Discount rate policy, and then it goes into Fed funds. So that's a subtitle there. As the discount rate, the Fed publishes an interest rate so that banks can borrow from them. So the discount rate is an interest rate. And let's say, for the sake of, I'm going to say it's 1%. That's just an example. It means nothing. I'm just using an example to bring more clarity to this. So definitionally, I have in the notes, it is the rate on overnight loans from the Fed to one of their member banks. So if Bank of America needs money, there's a ton of places they could go to get money, but they could also go to the Federal Reserve and say, guys, what's your price of money right now? Well, the discount rate is 1%. So Bank of America, for every day that you borrow money from us, because it's an overnight type of rate, meaning it could change at any point, that would be the overnight loans from the Fed to the bank. Now, no bank wants to go to the Federal Reserve. They don't like to do that because it's the Federal Reserve puts banks through all kinds of hell trying to borrow money. What you want to do is you would develop friends in the industry, what I call buddy banks. And I want to call a buddy bank and say, look, I need money. What rate will you loan me money? Well, the Fed funds rate. And that is a rate on overnight loans from bank to bank. And that's usually a little bit higher than this. This is maybe 1.25, 1.125, something like that. So if I called a friend of mine, maybe at Gulf Coast Bank, and I said, look, I need $1 million. This goes on all the time. And he said, well, my Fed funds rate is 1.25. So that's what he's going to charge me every day for the money that I have outstanding. And when I want to pay him off, I wire the money back to him, and the loan stops. It's a loan from one bank to the other. And there is a rate that's attached to the loan. And what is that called? The Fed funds rate. So guys, when this is a rate, this is the only one that's a rate. So a great question is, what is the discount rate by definition? It's the rate on overnight loans from the Fed to the banks. What is the definition of Fed funds rate? It's a rate of loans from bank to bank. Those are great true, false type of questions, ones that we don't miss, and it's a better way to understand what this is. All right, so when the FOMC is raising rates, and I'll show you this in a place on the Wall Street Journal. When the FOMC is raising rates, they're very specifically looking at the Fed's own rate. So if the Fed's rate is 1%, it's like, guys, at this meeting, the FOMC says we're going from 1 and we're going to, name something, 1.5. Okay, that is a very specific number. The market takes this number and reprices all of their interest rates, like your home equity lines of credit go up, your credit card interest rate goes up, and that's how they start affecting the economy. Anything that could reprice very quickly. All right, something that can't reprice very quickly is a 5-year car loan. You get the loan today and the loan interest rate stays the same for the whole length of the loan. if you go to get another car loan, it's like, oh, I drove this car for 3, 4, 5, 6, 7 years, and I'm going to get another one. Well, you would notice there's been a rate increase. Okay, so that's what's going on in financial institutions. Since last year, we've raised, we had 1.9 car rates, and now they're more like 5, because the Fed has raised rates very aggressively over the past year. I'll show you what that looks like. But that Fed funds rate, guys, it becomes a window. So because it's not specific, every bank could choose their own Fed funds rate. I could make up my own Fed funds rate at work and say, I want to charge 2%. I want to charge 5%. Well, nobody's going to borrow from me, and nobody's going to transact with me on a Fed funds basis because my rate is too high. They'll go to somebody else and get a better rate. But it's within the banking system. The Fed isn't so much involved in the Fed funds rate, but what they do say is, like, we're going to target the rate. We want the rate to move up in a particular way. So we're going to change what? We're going to change the discount rate policy. We're going to move this up a bit. And then what will happen? The Fed funds rates will then change within all of the banks. And again, I'll show you an example of that, and it'll add some clarity to it. Okay, so that's that simple. All right, so let me clean this up, and I'll go to the last thing, which is a reserve requirement. That's a money supply issue. All right, so reserve requirement is, read this on the discount rate. Reserve requirement is that when they are wanting to change the money supply, guys, what they do is they send the banks an email, so to speak, and they say, well, we want you to keep, we want to take money out of the system, out of the economy. So we'll go to the banks and say, guess what? For all the money in the checking accounts that you have for your customers or members, take 10% of all that money and send it to the Fed. And that's a reserve requirement. We are going to hold it, quote, on reserve for you, which is a fancy way for saying we're going to take it away from you. It might be, this is for checking accounts. It might be 5% for all savings accounts. So so the bank's saying, what the hell? I've got, I'm losing, I have a lot of money tied up. It's at the Fed. I can't loan it out. I can't make money on the money. So it's kind of a tax on the bank without it being an actual tax. It's taxing the liquidity of the institution. And if they're raising these, let's just think this through. If they're raising the reserve requirements, money is coming out of the system. So the money supply, if they're raising this, the money supply is falling. And the opposite has to be true. If they want to push money into the system, they will lower the reserve requirements, and the money supply will increase. Okay? That's simple. What is the Fed doing right now? They're taking money out of the system in a fairly big way, right? So they could do it through here, or they could do it through open market operations, through asset sales. They're going to sell you a bond, and money's going to come out. I'll show you that in a second as well. What are they doing? They're trying to slow the growth rate in the economy right now. Inflation is higher than they want it. That's one way to do it. The yield curve is inverting, as we talked about on the last video. They're really banging up the economy right now to try to get it to slow down. And guys, there's going to be pain to be felt. We were talking just last class about some of these banks that are failing, and it was due to a liquidity issue that they've taken. They were postured where they couldn't stand to lose a lot of liquidity. And if the Fed was fairly active for them, they're a $200 billion bank, so that's a fairly large bank in this country. They might not have had a lot to start out with. They might have been kind of operating on fumes a little bit, and it didn't take much to push them over. And that's what happened to the ones that we had talked about on Tuesday. All right, so let me clear this, and I'll show you what that looks like, just to make sure it's on the video. So I'm going to pause. I'm going to bring up another website, and I'll show you what it is. Pause recording. Okay, guys, I think we've seen this. So M2 is, you're probably not remembering that from, you might be remembering that from your macro class, but it's certainly a macro element, okay? And again, this is the Federal Reserve economic data. That's what FRED is. And you go out there, they have, they got a lot of data. So we could say, and I'm going to say to annotate, hang on a second. Clear. Say draw. Okay, so here's M2. And they give you, if you ever go onto the stlouisfed.org, and if you get into M2, you get into one of the graphs like you're doing here, you can go down and they'll give you a definition. Basically, it's all the coin and currency and circulation plus some certificates of deposit. It's a very aggregated number here. And we're right now at 21.1 trillion. Okay, so that's down from a high where it was right up here. But you see where the money supply has gone over time. And there's not been a lot of this very exaggerated portion here is because of COVID. And that's what brought on the inflation. So and guys, all that money finds a home. When that's coming in through stimulus payments, through any kind of asset purchases, the Fed was, if FOMC, they're pulling money. Okay, they're buying treasury bonds out of the financial institutions and injecting money in. So you get that, you get, where does the money come from? Where they can print it to go make those asset purchases. So for over a year, the Fed was injecting 1.2 120, I know it's 120 billion per month. Okay, for the last year or so. That's what that looks like right here. Okay, now they're taking out 95 billion a month. Okay, so that's what it looks like right here. And when this money found a home in various financial institutions and mutual funds and investment houses and in purchases of treasuries and so on, when you're pulling it out, it's not available. So what was happening to the bank on the West Coast, and there are two of them on the West Coast in California, one in New York. It's like, I can't, wait a minute, I bought long-term securities with that money. I went and bought, 20-year bonds, 30-year bonds. And when you've been increasing the interest rates, the price of the bonds have gone down. Now you want your money back. Now you want to sell me a bond or just withdraw money from the system. So these banks had to go in and sell their securities at a loss, which was a loss to the bank. And the one in question, that one Silicon Valley, they had to sell, a lot of stuff to get the money to send it back to the Fed. And they caused $1 billion loss to the bank. So that's serious money, big money. So this is what's happening right now, guys. We are all living in a very, very difficult time financially. And, they're whipsawing the economy, and the Fed has done that. And they admitted they did that. They said, we might have been putting money in too long. Okay, too long. That was going from 2021 to March 31st of 2022. Okay, and then on April of 2022, the next month, they started taking money out. So they were pumping it in like crazy. And then immediately they started taking it out, and what? They started raising interest rates. Okay, so that was very problematic there. And that's what we're going through. It's like withdrawal pains. It's like somebody was taking heroin and somebody all of a sudden said, you can't have any more of your drugs. And, we've never seen money come out of the economy like this. And something else I'll show you with the Fed funds rates. I'm just going to keep talking while I'm pulling this up. So I'm going to go to wallstreetjournal.com. And I think they got a good place where you could check rates. Let me see if this is going to cooperate. There we go. So I'm going to go to markets. I'm going to go to market bonds and rates. Okay, they're going to show a yield curve because they should. All right. All these financial sites, they need to show a yield curve for the importance of it that I described in the last video. They're showing you a year ago and they're showing you now. And then for the Wall Street Journal, I like to go to their site because it gives me an idea, not theoretical stuff, not just teaching classes, but it gives me an idea of what's going on in the economy, because I have to price off of this. I have to look at these prices and determine how competitive I am. So here's the Wall Street Journal Prime. That is a central rate, okay, in the economy. That's usually what a corporation a bank will loan its best corporate customers. So look what it's done. It's been increased by 4.5% over the past year. And so has the Fed funds. And what did we say? The Fed funds a target because it's got this window there for all other banks. I described that a little bit earlier. So that's been up by 4.5%. Okay, so these are lockstep with the economy. As soon as the Fed raises the discount rate, the target rate will move, and then the Wall Street Journal prime rate will move right away. when you get into lending products, okay, these are lending rates by themselves, but when you get into stuff that affects the consumer, you got some movement, okay? So here was the low of a 30-year mortgage if somebody was going to buy a house. Here was the high some time ago. This was last week, and this was yesterday. So you could see that the rates have, this is, it's increased certainly from a year ago, but it's not gone up by the amount that they've raised the short-term rates. So that's where your yield curve comes in. Remember what it looked like. Remember what the yield curve looked like. It didn't increase as much. Here's 450 basis points right here on the front end of the curve. But on the long end of the curve, mortgage rates haven't changed as much. So that's what they're trying to communicate to us here. And since these rates have gone up consistently for the past year, but mortgage rates have gone up and then they come down. Places like, my work, that we try to be a little bit more competitive. And if I could cut a few basis points off of my 30-year mortgage rate and still make a little money, somebody might be inclined to do it. But guys, here's where, a 5-year adjustable, a 48-month car loan, we're seeing what they were, and look what they were back here. 1 year, 3 years ago, a 5-year car loan, meaning before COVID, was, a number that started with a 2. Now look what's going on. Right now, it's a number that starts with a 6, sometimes a 7. Okay? So what they're doing works, because there's an old adage out there that says, never fight the Fed. It's like getting hit by a train. You're not going to get in the way of this and say, well, I'm not worried about what they're doing. I'm going to do what I want to do. And I want to, still do car loans, 48-month car loans at 2%. Well, you can't even get the money to loan it out at 2%. You're paying, something more closely related to the Fed funds. So if I'm borrowing money from my buddy banks, those that have extra money, which is not a lot right now, look at the 52-week low. This a year ago was basically at 0. And they raised it 450. So if you add 450 to this 0, there's your 450. See how that works? Very, very methodical. You could look at this and just connect the dots. So if I have to go to my buddy banks and get money at 450, then I have to charge 650, 675 for a car loan. There it is. It's all kind of coming out in front of us. But guys, that's basically it for the Federal Reserve. So it's just that very short outline. It's understanding what they do. They're the central bank of any economy. Every major economy has their own central bank, and they're doing what our Fed is doing right now and going through what our Fed is going through right now. And it's, well, better said would be that, the people in their economies are going through this. European Central Bank is going through this. Russia's central bank is making changes. I mean, it's a difficult time when this inflation hit through COVID, because everybody was cutting rates and everybody was increasing the money supply, and then everybody got inflation. It's just a matter of how much. So there it is. There's a couple of rate sources. There's a couple of sources where you would look for this if you were kind of in the money business. So you're in banking, somebody not far away from you is doing this if you're not doing it, meaning that it's not part of your job. But for those who want to get into, money management, this conversation would be very routine, and you'd be checking on these things and understanding how it impacts your business. Okay, guys, so I'm going to stop the recording here. You'll get an email, or by the time you're hearing this, you would have gotten the email already with the link on it. So y'all have a good weekend.